Good morning, everybody. We're going to call this hearing together. I'd like to welcome everybody. This is the oversight hearing for the Assembly Local Government Committee and the Assembly Banking and Finance Committee. And our goal here is to do an informational hearing on the PACE program and the experience of local agencies. There has been a hearing on this a couple different times, but as we continue to evolve and move along, we want to make sure that we keep our fingers on and our eyes on the impacts of the program, how they're being implemented, and most importantly, I think, how consumers are being impacted by this. So I want to welcome and thank Mr. Dababneh for doing this together. I think the more collaboration we can do, the less things fall through the cracks, and then really good policy gets established. Opening remarks, Mr. Dababneh.
I'd just like to thank my colleague and chair from Stockton here for doing this joint hearing today to help fight climate change, lower utility bills, and increase home value. This is a pitch homeowners are hearing across our state, and there are good and bad things to this program, but the PACE program has been an environmental success. There's no doubt about that. This is something that's been really given thousands of Californians an opportunity to upgrade their house. But it's unfortunately also created unintentionally a marketplace that allows contractors to sell financial products to homeowners without any consumer protections, uniformity, transparency, and accountability. Currently, there is no requirement for basic disclosure, and homeowners are often misled to believe that the PACE program is subsidized by the government, or that it is an official government program carried out solely by the government. And this carries a risk that sellers and buyers of homes need to understand that we don't think enough information is being provided. PACE provides homeowners an alternative finance to the upfront costs needed to make energy efficiency upgrades, and that's something I applaud. I know my colleague here applauds that, and I can't find anyone in our caucus that wouldn't consider that a success. However, we don't think these things have to be mutually exclusive to consumer protections, and so I'm very excited today to be able to look at one particular issue of this in terms of the lien and the super lien status that goes along with this. We want to make sure that we improve this program, make it more sustainable, and really open it up for a greater marketplace of consumers. Right now, I talk to average constituents in my district every day that would be interested in a program like this, but are scared off at the idea of having a super lien on their property. They know that in this volatile housing market that is still somewhat fragile from the recession a few years ago, that having the ability to sell their home quickly, having access to the value within their home is something that's very important to them. And I think if we can solve the issue of the super lien and make sure we have robust consumer protections, including a really strong disclosure, this PACE program will be stronger and more, really, to me, appealing to more consumers that gives us a better ability in our state to meet our long-term environmental goals. So I want to thank our chair, to all my colleagues of both committees. Thank you for being here today. You know, to get colleagues a couple days after an election on a Thursday after session to stay and be part of a hearing like this is really a testament to what an important issue this is. And I just want to thank all the stakeholders as well for being thoughtful, and I look forward to a robust discussion today.
Okay, thank you. So our first panel is going to be an overview of the PACE program in California. And so we're going to ask to come up, please, Carolyn Chu, Senior Fiscal and Policy Analyst from the LAO, Dina Carrillo from the Executive Director of the CATFA program, please. And David Hochschild, who is a commissioner from the California Energy Commission. Okay. Thank you very much, and we're going to try to limit you to 5-10 minutes each. And
Sure.
then members, please, we'll hold our questions till after they're done, and we've left time at the end for that. Thank you.
Good morning, chairs, members. My name is Carolyn Chu from the Legislative Analyst's Office. The Sergeant has just passed out a handout that I'm going to speak from. I've been asked to give a brief overview of the PACE program from the local government perspective, the authorizing statute, that sort of thing. I'll move rather quickly through the handout, but I'm happy to answer any questions at the end. So moving to page 1 of the handout, as you all know, charter cities historically have had the ability to create financing districts to pay for a variety of improvements. In 2007, Berkeley was the first to use this authority to create a mechanism for property owners to finance energy improvements on their own property. Under Berkeley's original program, property owners can voluntarily install energy improvements on their property and repay the cost of those improvements through their property taxes. Today, all cities and counties can establish these types of programs voluntarily. At their core, PACE programs are a means of providing the upfront capital for energy improvements. The improvements must be installed on real property, and possible improvements include renewable energy sources, vehicle charging infrastructure, or water efficiency upgrades and seismic retrofits. There are two options for local governments to voluntarily establish these programs. The first, established under AB 811, allows local governments to designate an area within their jurisdictions where property owners can voluntarily enter into these contractual agreements. This made amendments to the Improvement Act. The second option made amendments to Melrose districts and allow local governments to form community facilities districts, which can levy special taxes. Again, typically local governments allow property owners to enter into these contracts voluntarily. The basic difference between these two options is that under AB 811, or the improvement districts, local governments can join JPAs, or joint powers authorities, to administer the programs. Under the Melrose programs, or the SB 555 programs, there are a broader range of possible properties that can be improved. In either case, the assessments and special taxes under the PACE programs are liens against the properties themselves, not the individual property owners. So moving to the second page, this is a sort of stylized property tax bill. You can see under the fourth item down on direct levies, there's a Melrose district charge, and that could potentially be for some sort of PACE type improvement repayment structure. Moving to the third page, historically, property taxes have had senior lien status to ensure local governments receive their revenue and can repay public works for which they may have issued bonds. Because PACE assessments are paid through the property taxes, these debts are given are afforded a similar senior lien status. In the event of foreclosure, property taxes typically must be paid first. Moving to the last page of the handout, there are hundreds of local governments that have authorized PACE programs across the state. Typically, local governments have opted to have a third party administer these PACE programs, whether it be through a JPA or directly by the local government. When the legislature first established this program, typically local governments were administering these programs themselves. So moving forward, a couple of questions for the legislature to consider. The first is, what mechanism might be most effective to incentivize individual property owners to make these types of improvements on their property? Are these financing mechanisms most attractive to property owners, or alternative tax incentives like rebates or otherwise more attractive to homeowners or property owners? And secondly, related, does giving senior lien status or is giving senior lien status critical to making these types of investments up front? Given the significant capital involved, investors may want significant security if to invest in these types of programs. And a question for the legislature to consider is whether or not the security afforded by the senior lien status is necessary to continue making these types of loans in the future.
Okay, thank you. Ms. Carrillo?
Good morning. Thank you, chairs and members, for having us here today. My name is Dina Carrillo, and I'm the Executive Director of the California Alternative Energy and Advanced Transportation Financing Authority, otherwise known as CATFA. For those who don't know us, we're housed in the State Treasurer's Office, and we're here today to talk about the residential PACE reserve that CATFA runs on behalf of the state of California, as well as a working group that we've developed at the request of the legislature to establish comparative criteria to evaluate California's energy efficiency financing programs. I have provided a number of slides that provide some background on growth, as well as the structure of the PACE reserve to address the risks that have been raised by FHFA. In California, and these should also be in your handouts, PACE as a financing structure was established and advocated by the local governments as an innovative approach to a standard local government financing tool to finance energy efficiency retrofits and help meet our greenhouse gas reduction goals. In 2008, AB 811 was approved, and the first PACE financing launched and it were issued in California in 2009. That same year, FHFA issued a letter voicing concerns over the first priority lien status of PACE. In 2010, and I apologize, when we get to history, I'm going to be reading from some of my notes. After PACE launched in California, FHFA began voicing concerns over the first priority lien status. This culminated with a directive issued by FHFA in July 2010, which directed Fannie Mae and Freddie Mac and the Federal Home Loan Banks to not purchase or refinance mortgages with PACE liens and to undertake protective actions redlining PACE communities. This directive led some PACE administrators in California to pause or suspend their residential programs, and some continued to move forward, a choice made at the local government level. The state of California and other entities brought an action in federal court arguing that the directive was a rule under the Administrative Procedures Act and needed to be adopted through formal rulemaking. District Court ordered FHFA to begin the rulemaking process, and they did. FHFA published an advance notice of proposed rulemaking, soliciting comments, and subsequently issued a notice of proposed rulemaking, which responded to these comments in 2002. Since then, FHFA has retained its concerns regarding PACE and the financial risks first lien PACE programs pose to the mortgage holders. However, in 2013, the Ninth Circuit Court of Appeals held FHFA's directive was a lawful exercise of its authority as the conservator of the enterprises, and that it was not subject to judicial review. FHFA did not continue with its rulemaking process. In 2013, the California legislature passed and Governor Brown signed SB 96, which directed CAPA to establish a PACE risk mitigation program for PACE financing to increase their acceptance in the marketplace and protect against the risk of default and foreclosures. So what is the PACE loss reserve? CAPA, in coordination with our stakeholders, looked at the different issues raised by FHFA and determined that the best way to target public funds would, in essence, to be to develop a program that put first mortgage lenders in the same position they would have been with or without the PACE lien. So what does that mean in practical terms? First mortgage lenders are the highest at risk if they ever foreclose on the property due to a borrower's default on the mortgage, where if they own the property, they have to then pay the property tax. Alternatively, if it's a lack of the borrower's default or the property owner's default on the property tax, if there was ever a forced sale and the first mortgage lender was not made whole. PACE administrators can participate in the program by applying to CAPA, and then we will cover their whole reserve or their whole portfolio as long as it meets our underwriting criteria. So what does that mean in the real world? Assume you're a homeowner that puts on an energy efficiency and a renewable retrofit. This is a little high at $20,000, and so you'll have an annual payment of $2,500. If the property owner defaults on a mortgage, the bank takes possession of the property as it would under standard mortgage default until the property is resold. And at that time, they'd pay the property tax. In this scenario, the bank would have to pay $2,500 of the annual PACE assessment, and the remaining PACE assessment would stay with the property. In the second example of a forced sale, same example, let's say that the auction price is $210,000 for a home, the outstanding property taxes is $50,000, including $15,000 in outstanding PACE assessment. The first mortgage lender would be made whole for the amount of the outstanding PACE assessment. CAPA was asked to establish some basic underwriting criteria that's included in statute as well as in regulations. This could include the value of the home, the amount of equity that's required in the home, and other elements as defined in statute. When the program launched in June 2014, CAPA enrolled 8 residential PACE programs. In 2015, CAPA enrolled 4 new PACE programs. And so far in 2016, we've enrolled 1 other program and expect a few more to enroll. A few of these are administered directly by local governments, some are hybrid, and some by through JPAs. This map shows the growth of residential PACE from June 2014, at which point 264 cities and unincorporated areas with 25 counties had at least 1 residential PACE program. In February 2016, that increased to 464 cities and 47 of California's counties. I apologize for those in the back. This lists the PACE activity to date. Enrolled PACE programs must report to CAPA on the size and status of their portfolios twice a year. One other thing to note is that PACE programs that enrolled early were allowed to enroll their whole portfolio, even if they didn't meet our standard underwriting criteria because they've been issued in 2009. And so our current portfolio includes PACE assessments back to 2009, 2010. This is the growth of PACE One little note here is that the column on the left is activity and growth of projects and dollar value for a 6-year period. And the column on the right is all those projects that we've done in 2015. So as you can see, PACE is growing. It is a key tool to meet our energy efficiency and renewable goals. Today, our $10 million loss reserve is supporting a portfolio of over 56,000 financing across the state, valued at about $1.2 billion. And that value is dated as of last March, I believe. Predominantly, 67% of the projects include energy efficiency projects. 19%, and this information is from Pace Nation, which can provide additional information. 20% on renewables and about 14% mixed. I know we have information on water as well, but that's not here on this slide. One note on the estimated environmental savings. Each PACE program is required to report to CATFA on its estimated environmental savings. One thing that we've been working with the programs on is how to standardize those estimations and how we look at what our actual impact is on energy and renewable savings. What CATFA is doing today, we are looking back at our program to increase the data points collected from enrolled PACE programs. We're looking at our underwriting criteria to see how it can be strengthened. And we're launching our first audit of the PACE programs now that we have a year of activity. And we've been participating in a number of working groups that have been established by both the PACE practitioners as well as other stakeholders on establishing best practices statewide for the PACE programs. One other thing to note, besides the comments from and position of FHFA, is that this last year, other federal agencies have released or announced that their requirements for PACE. So in January 2015, HUD issued guidance as to when a HUD property and when HUD would consent to a first priority PACE lien on a multifamily property. In addition, FHA, single family housing, in August of 2015, they announced it'll issue guidance that allow borrowers to use single family FHFA financing for properties with existing PACE financing, and they will be issuing guidance. We do anticipate that their guidance may require some limit of subordination, but you could see that we're getting different messages from entities at the federal level.
And no guidance yet.
And no guidance yet. I have been informed that it is forthcoming a few times, and I understand how that works with program development. So I'm not criticizing, but that is not an easy issue.
Check is in the mail.
Wow. If it were easy, we wouldn't all be here.
Right.
Yeah.
A few moments, if I may, talk a little bit about the working group on energy efficiency financing programs. Last year, CATFA was given the ability and the request by the legislature to really take a look at California's energy efficiency financing programs. They're very different statewide and administered by a number of different entities, specifically to look at how you would develop comparative criteria to evaluate these programs, looking at PACE on-bill financing, which is administered by the IOUs, as well as a program that CATFA is developing now, which provides an open market platform for unsecured financing for energy efficiency. We have had fun with this project the last year, so thank you, as we've pulled our stakeholders together to talk about different criteria and how you look at these types of projects. Some of the things that we've been looking at is how do you know that this energy savings is attributed to the program financing? How do we know that we're growing the pie and not just displacing the pie? The cost effectiveness of programs, how we're actually moving the market. To what extent is PACE today helping the securitization and the secondary market of energy efficiency financing? So conceptually, when someone has an HVAC go out, they can go out and find financing, and the market understands the risk. We're also looking at energy savings, market penetration by market segment. We know that there is a bigger hurdle when we have a split divide or perhaps multifamily that has is focused on affordable. We've also been looking at customer satisfaction and consumer protection issues, as well as diagnostic information. And that's a really dry way to talk about financing terms, interest rates, defaults, delinquencies. Some of our primary challenges that we've discussed through this working group process is that there are various policy goals. If you look at some of the authorizing PACE statutes, not only is it to meet our greenhouse gas emission goals, but it's also a job creator. In a way for local governments to invest directly in their local community. as well as when you compare apples to oranges. I have a colleague who says, I like fruit, I want fruit salad. But they all have different constraints, different issues, administered differently. At some point, it might not necessarily be an interest rate, but it might be the ease of using a product. Despite how many commercials I see that say 0% financing for a car, I'm not going to go out and buy that new car until I need to. And then the question is, how do we have the right financing there at the time? And then some of the evaluation, measurement, and verification specialists, because that term exists, and that is a bigger group than you would think. They have all shared that we are on a new methodological frontier. So for us energy geeks, we're really geeking out in how we truly evaluate energy savings and make sure that we're making a difference with a finite amount of public dollars, or I would say with the legislature's intent to use a public local government infrastructure system to leverage private capital. And that's it for this oversight.
Mr. Oakes.
Good morning, Chair Eggman, Chair DeBobne, members. Thank you for the opportunity to appear before you. I'm David Hochschild. I'm a commissioner with the California Energy Commission. I just want to start by saying I spent my entire professional career in and around renewable and efficiency policy. And in my view, the PACE program is the single most effective policy instrument to reach this challenge of existing homes and upgrading energy. We're performing poorly as a state on helping our citizens save money through their energy bills, and very few policy instruments exist that actually work. And the advantage that I see to this program is it doesn't cost the state money. And I just want to highlight, the governor has been personally a champion for this program. There are very few issues where the governor's actually brought to the President of the United States. PACE is one of those, and it's for good reason. We have around $2 billion of PACE projects completed in the state, and we did set up this $10 million loan loss reserve to protect the lien holders, and it hasn't been touched. And I just think you look at what are we getting for that investment, 15,000 jobs, both energy and water savings. And let me just point out, these twin challenges of the need to reduce water use. We're in a drought, and in my view, we're in potentially a period where the drought is the new normal, to be interrupted periodically by years of what used to be normal weather. And we're struggling on reducing water use, to where we need to get it to, and the need to reduce energy from polluting power plants. And I have looked at PACE programs around the state. I've visited Renovate America, Renew Financial, and so on, and I'm very impressed by what I've seen, particularly in the absence of other programs that meet this need. I do want to point out, I think in the debate and discussion about this, one critical point is often lost, which is the stuff that's being financed through PACE saves money for the homeowner. It's not like people are adding a hot tub or some other feature that's going to cost them more. We're putting people in a better position to afford their mortgage, which is why when the Institute for Market Transportation did their study, they found energy efficient homes, people are 32% less likely to default if you live in an efficient home. It's not rocket science. You have more money in your pocket. And I think that point is often missed. I would point out the origin of the PACE program originally was it came out of Mayor Tom Bates when he was at Berkeley, based on the utility undergrounding model, where you have an assessment for a property that adds a cost. And that's a well-established model. We're talking about now a cost that's resulting in a savings, a monetary savings of your gas bill, your water bill, your electric bill. And you look at these old homes today, one of the challenges we have, look at these homes where people have been living there 40, 50 years. The life cycle of a toilet, right, is over 30, 40 years. And so if you have a toilet that uses 7 gallons of flush, you can upgrade it to 1.2, which is the standard. You have a furnace that's 60% efficient, you can upgrade it to 97, 98%. Leaky single pane windows, older lighting, this can all be fixed. And I think this is working because it's making it really simple for the homeowner. And then the loan stays with the property and they can move, and that makes sense. So I am generally very impressed by what I've seen. And I do want to point out, if you look at the content of 350, I'm the lead for renewables. We are moving very quickly on renewables. We went from 12% renewables in 2008. We're at over 25% today. We're going to exceed 50% by 2030. We're going to hit that target. The efficiency goal is much more challenging. Cutting energy use by 50% by 2030 is a tough nut to crack. This is one of our key arrows in our quiver. So I just close with that.
Okay. Thank you. And so thank you all for your presentation. Clearly we can see this program has taken off like people. I mean, I think it's the slides are riveting that from just 2 years we have such a huge explosion. And I know I was in local government when the program first was established, and everybody was very excited. We weren't able to participate in the beginning, but I think with the introduction of the third party entities, it's really been able to take off in a way that people didn't anticipate. So one of the questions I would have, is there a need for a larger oversight for the PACE administrators, in your opinion? And if so, what's the appropriate body to do that?
Why don't you take first crack at that?
I would say that as originally envisioned, not that I am not supposing to know legislative intent here. So with that large caveat, that as I see the legislative language, it was originally determined that it was a local government tool. Mm-hmm. Now, while I recognize that JPAs have a unique role in local government, it has been the Treasurer's Office long-standing position that JPAs in and of themselves don't have the oversight or the rigor that they need from a local government perspective. So we are in a catch-22 position, I believe, because a lot of local governments don't have the resources or the capacity to administer and the public-private partnerships have been a unique tool. I do believe that more oversight is necessary for the PACE programs, specifically because they haven't been run through the local governments as originally designed. In talking to the PACE participants, I have seen all of them being good actors to come to the table and acknowledge that that is an important role in creating some best practices and standards. In some of those discussions, it has been asked if CATFA was the appropriate place for that. I would say that is not our core skill set. We are based in the State Treasurer's Office. We are a financing tool to work with our policy leaders. CATFA is not a regulator. I think that the members may be interested in looking at who regulates in our state our standard financing entities, because that is what the question has become. There is financing going on, there isn't a direct regulator. So looking at our existing structure versus developing a new structure.